Listen to me very carefully because I'm only going to say this once, and if you miss it, that's on you. There is a quiet rule change happening right now in the silver market that is more significant than anything I have seen since the dot-com collapse. And I have been in rooms where billionaires quietly repositioned their entire portfolios around exactly this kind of shift, while retail investors sat at home watching cable news and arguing about things that do not matter. One single dollar to their net worth. Silver, the metal your grandmother stuck in a drawer and forgot about, has just become the most strategically important industrial commodity on the planet, and almost nobody in the regular investing world has any idea it's happening. Not 1 in 1,000, not 1 in 10,000. This is not hype. This is not a YouTube scare tactic. This is math, regulation, and geopolitics colliding at the same moment. And if you are not paying attention, you are going to get absolutely run over. If you're the kind of person who wants to understand how money actually moves before the crowd figures it out, then subscribing to this channel right now is the single smartest financial decision you will make today. The information I am giving you in this video costs thousands of dollars inside professional investment circles. I am handing it to you free of charge. All I ask is that you hit subscribe and turn on notifications and show up ready to learn, because everything I cover here is the kind of thing that separates the people who build real wealth from the people who wonder why it never happened to them. Let me show you something that the financial media has zero interest in showing you. Because the financial media makes money when you watch their shows, not when you make money from your investments. There is a ratio, not a price, not a headline number, not some talking head's opinion. A ratio. And ratios are the most honest thing in finance, because they strip out all the noise. Inflation distorts prices. Monetary policy distorts prices. Some guy in television saying something loudly distorts prices. But a ratio just tells you one thing compared to another thing. Clean and cold and mathematical. The ratio I want you to burn into your brain is silver divided by the S&P 500. And what this ratio tells you is how expensive or cheap silver is compared to the American stock market at any given point in history. When the number is high, silver is expensive relative to stocks. And when the number is low, silver is cheap relative to stocks. Simple. No jargon, no complexity, just a number on a chart that tells you where you are in the cycle. Now, here's where it gets serious, and I need you to stop whatever else you were doing and actually focus. In the 1980s, this ratio hit a level that was 30 times higher than where it sits right now. 30 times. Not 30%, 30 times. That means silver compared to the stock market was 30 times more expensive than it is today. And then in 2011, just 15 years ago, not ancient history, not some tulip mania from the 1600s. 15 years ago, silver ripped back up and was trading at roughly 2.5 times where it is right now relative to stocks. That is a 250% move compared to current levels. And in between those two massive moments in the late 90s and 2001, around 2015, every single time silver got this cheap relative to stocks, every single time without exception, a massive multi-year rally followed. Every single time. That is 50 years of data telling you the same story over and over again. And right now, today, we are sitting at one of the lowest readings in that entire half century. This is not an opinion. This is not a feeling. This is data printed in black and white on a chart that anyone can look at. And the chart is basically screaming at anyone with eyes to see it. The question is whether you are one of the people who sees it or one of the people who finds out about it 2 years from now when it is too late to matter. Now I am going to tell you about the rule change, and I need you to stay with me here, because this is the part that almost nobody knows, and it is the part that matters the most. The rule change is called Basel III, and I know that sounds like the most boring sentence ever constructed in the English language, but bear with me for 60 seconds, because this single regulatory change is the most important structural shift in the silver market since the Hunt brothers tried to corner it in 1980. Basel III is a banking regulation that came out of Switzerland, and buried inside it is something called the net stable funding ratio. Here's what it means in plain language, and I want you to write this down. For decades, big banks could hold something called unallocated silver. Unallocated silver is not real silver. It is a promise. It is a piece of paper that says we have silver without any specific bar with your name on it sitting in a vault anywhere. It was an IOU system, and the banks ran this IOU system to generate enormous trading books, where for every single ounce of real physical touchable silver, there were many paper ounces floating around in the system. We are talking about leverage ratios where roughly 8 paper ounces existed for every 1 real ounce of actual metal, 8 to 1. And it used to be far worse than that. Under the old rules, running this paper-silver operation was a profit center for banks. They made money on it. They loved it. It gave them tremendous ability to influence prices and run massive trading positions without ever having to store a single bar of real metal. But Basel the Food changed the math on them permanently and brutally. Under the new rules, holding unallocated silver cost banks real money for every $100 of unallocated paper. Silver they hold. Banks now need to hold $85 in cash or cash equivalents to back it up. 85%. Write that number down. 85%. That means what used to be a high-margin profit center has been transformed almost overnight into a cost center, a loss-making operation, a liability sitting on their books instead of an asset. And what do banks do when something stops making them money? They exit it quietly without a press conference, without a headline, without asking for your permission or your opinion. Several major institutions have already walked away from silver clearing entirely. This is a public record. It is not a conspiracy theory. It is a business decision made by very smart people in very expensive suits who looked at the numbers and said, this no longer works for us. And as they exit the paper market, they are being pushed by regulation, by mathematics, by the cold logic of profit and loss into real physical allocated silver, real bars, real metal, real stuff you can hold in your hand. And when paper promises get replaced by actual physical demand for real silver, there's only one direction the price of that physical silver can move: up. The floor under silver just got structurally higher. And it happened quietly in the background while the rest of the world was arguing about things that do not matter to your portfolio. Now let me add the second layer on top of Basel III. Because if Basel III was the first punch, what China just did is the second punch landing on top of it. And together they are a combination that the silver market has genuinely never seen before in its modern history. As of the beginning of this year, China replaced its 25-year-old silver export system with a very tight, very restrictive licensing regime. In plain English, silver does not leave China the way it used to. Only a small handful of approved firms can export silver out of China. Now that is the rule change. That is the locked door. And now let me give you the number that makes that locked door terrifying for the rest of the world. Chinese refiners handle an estimated 60 to 70% of the world's refined silver exports. 60 to 70%. Stop and think about what that means. More than half of the world's refined silver flows through Chinese refiners. And China just put a lock on the door controlling how much of that silver gets to leave. Every solar factory outside of China, every electronics manufacturer outside of China, every medical device company, every EV producer, every data center builder outside of China suddenly has to compete harder for a smaller pool of available silver. The U.S. government has officially designated silver as a critical mineral, which tells you everything you need to know about how seriously the people who actually understand supply chains are taking this when your government slaps a critical mineral label on something. They are not doing it for fun. They are doing it because the people who briefed them on supply chain vulnerabilities told them there is a real problem here that needs to be managed. That is not a bullish opinion. That is a policy response to a structural reality. Let me hit you with the demand side of this equation now, because the supply story is only half of what is happening in a single month. 1 month, China imported 836 tons of silver. That number means nothing to you until I tell you it was 78% more than the month before and 170% more than their 10-year average. 170% above their 10-year average in 1 month. And the reasons behind that demand are not going away. They are not a one-time blip caused by some temporary factor. They are structural. They are growing and they are permanent for the foreseeable future. Chinese retail investors priced out of gold because gold has run so hard for so long started buying silver bars. Silver became the affordable safe haven, the every person's store of value. And when you have 1 billion plus people with a growing middle class deciding that silver is their financial security blanket, that is not a small demand driver. That is a demand wall. But the retail buying is almost irrelevant compared to the industrial side. Here is the number I want you to tattoo on the inside of your eyelid so you see it every time you close your eyes. The solar industry alone consumes 20% of the world's annual silver supply. 1 in 5 ounces of silver mined in this entire planet goes into solar panels. And the solar industry is not slowing down. It is accelerating. On top of solar, electric vehicles use roughly double the silver of a traditional gasoline-powered car. Every EV coming off a production line uses more silver than the car is replacing in the global fleet. And then you have data centers, the physical infrastructure of artificial intelligence, consuming silver at a rate that was not even in the models from 5 years ago, because nobody predicted AI scaling at this speed. Add 5G infrastructure, add medical devices, add every modern application where electricity has to move fast and reliably, because silver is the best electrical conductor on Earth, and there is no substitute that performs at the same level. All of this demand is happening at the same time. Solar, EVs, AI, hardware, medical technology, 5G. And simultaneously, the world has been in a silver deficit, consuming more than it produces for 6 consecutive years. 6 years in a row, the world has been burning through its silver stockpiles without fully replacing them. 6 years of eating into reserves built up over decades. You cannot do that indefinitely. Eventually, the math catches up. And when it does not catch up slowly or gently. Markets do not correct gradually when a structural imbalance finally tips. And they correct violently, quickly, and in ways that reward the people who saw it coming and punish everyone else. Now, I am going to give you the actual framework because information without a system for using it is just entertainment. And I am not in the entertainment business. I am in the results business. So here is the 3-signal framework, and these are the 3 things I watch before I change my positioning on silver in any meaningful way. Signal 1 is the ratio, and I already showed you the ratio. Silver divided by the S&P 500. This is your compass. This is your North Star. When this ratio is at extreme historic lows minus, which is exactly where it is right now, the risk-reward calculation of adding silver exposure moves dramatically in your favor, based on 50 years of data. When the ratio is stretched to extreme highs, the way it was in 2011 or in the 1980s, you are late to the party and the risk-reward has flipped against you. You do not need a Bloomberg terminal to track this. You do not need a friend who works at Goldman. You just need to know where the ratio is today compared to where it has been over the last half century. And you need to ask yourself one honest question. Is silver cheap or expensive relative to everything else? Right now, the answer is cheap. Historically, generationally cheap. Signal 2 is the global supply and demand balance. And the organization that tracks this most rigorously is the Silver Institute, which publishes something called the World Silver Survey every year. This report tells you in plain numbers whether the world used more silver than it produced in any given year. The answer for the last 6 years in a row has been yes. The world used more than it produced. 6 consecutive deficits. And the deficit is not shrinking because demand keeps growing. While new mining supply is structurally limited, you cannot build a new silver mine in a year. You cannot snap your fingers and increase refined output by 30%. Supply response in mining takes years and costs billions, and the demand side is not waiting around. So you watch the deficit number every single year like a hawk, because as long as that number stays negative, as long as the world is consuming more than it produces, the structural case for silver remains intact, and the pressure on price keeps building. Signal 3 is the rule book, and this is the signal that almost nobody tracks because most people find regulation boring, and that boredom costs them money. The biggest price moves in financial history do not come from clever stock picking or brilliant market timing. They come from rule changes, from moments when a regulator, a central bank, or a government rewires the system in a way that forces money to move in a specific direction. Basel III, pushing banks out of paper into physical silver, is a rule change that is still being implemented. The U.S. version of Basel III implementation is coming in the next 1 to 2 years. The U.K. implementation is approaching. Every country that rolls this out adds another layer of structural demand for physical silver, while simultaneously reducing the ability of large institutions to suppress price through paper leverage. And the U.S. government designating silver as a critical mineral is a rule change that opens the door to strategic purchasing, supply chain protections, and policy support that did not exist before. When you see the ratio at historic lows, the deficit at 6 years and counting, and multiple simultaneous rule changes, all pointing in the same direction, you are not looking at a guess or a hope or a feeling. You are looking at a convergence of signals that has a documented historical track record of preceding major moves in the silver market. That is the framework. 3 signals: the ratio, the deficit, the rule book. Watch all 3 when all 3 are aligned the way they are. Right now, the historical data says pay very close attention. Now, before I let you go, I am going to give you the part that most people in this space will not tell you because they want you excited and emotionally bought in and ready to do something impulsive with your money. Silver is volatile. I mean genuinely, brutally keep you up at night. Volatile. It can drop 10% in a single day. For reasons that seem completely random, it crashed hard after both the 99,980 spike and the 2011 spike. The same forces that drove it up drove it back down when sentiment reversed. If you cannot psychologically survive a 20% drawdown without panic selling at the worst possible moment, then silver should not represent a large portion of your portfolio. Full stop. This is not an asset you bet the farm on. This is an asset you understand deeply, size properly relative to your total financial picture, and hold with a written plan that you made when you were calm and rational, not when you were either euphoric because it was ripping upward or panicking because it was getting crushed. Get professional financial advice for your specific situation. Know your time horizon. Know your risk tolerance. Know your income streams and obligations. And never, under any circumstances, make a significant financial decision based solely on a single video from the internet, including this one. My job is to hand you the tools, the framework, the historical data, and the pattern recognition. Your job, always, without exception, is to make your own decisions with your own money. The people who consistently build wealth are not the people who guessed right one time. They are the people who replaced guessing with a rule book, replaced gut feelings with a checklist, and had the discipline to follow the system, even when their emotions were screaming at them to do something different. That is what separates the investors who end up wealthy from the investors who end up wondering what happened. The rule change is real. The data is real. The framework is real. What you do with it is entirely up to you. But at least now you cannot say nobody told you it was.